Michael, welcome to the Network State Podcast. We're going to do a special episode today where we go through Michael Saylor's new roadmap and digital assets framework. Michael, welcome.
Yeah, thanks for having me. Really happy to be here.
Awesome. Okay, great. So you just published this digital assets framework, the principles and opportunity for the U.S., right? It's a PDF. It's gotten more than 500,000 views. Maybe you can talk through it, say, what you were thinking about when you're writing this and what the goal is.
Sure. So first of all, for the past 4 years, I've been watching the crypto debate go on, in the United States and everywhere else in the world. And I think a lot of times everybody's yelling and there's a lot of talking past each other and there's a lot of friction. And it seems to me that if our goal is to move forward in a constructive, progressive fashion, we'd benefit from a framework. So I put together a digital assets framework along with a set of principles, and I try to talk a bit about the ideology, what's the vision, and what's the opportunity. And I did it from the United States point of view because I think the United States really needs to lead in the digital assets arena. And if they do, I think it's quite likely that'll provide the air cover that will allow similar digital assets frameworks in the Middle East and Singapore and Japan and Europe, et cetera, and South America. So let's look at the different steps. I've got a taxonomy of different assets. We talk about how we legitimize these assets and then what are the practices we need in order to how do we make this practical? And then the fourth section is on the vision. And the fifth section is really the opportunity for the United States. So
why don't we start with the taxonomy, right? So you have 6 definitions there. Most of them I think people have heard, but why don't you go through them? Commodity, security, currency, token, NFT, and ABT. I hadn't heard the last term in that acronym, the asset-backed token, but go ahead.
So there's a lot of types of digital assets. A digital commodity is an asset without an issuer backed by digital power. A digital security is an asset with an issuer and it's backed by a security. The third, a digital currency, it's an asset with an issuer, but it's backed by a fiat currency. A digital token would be a fungible asset with an issuer. Then you've got digital NFTs. It's a non-fungible asset with an issuer offering digital utility. But the difference is you could have 10 million fungible tokens and we get that. But if you have 100 different NFTs and they give you 100 distinct rights, then it's something different than the token. Now, the last one, digital ABT, asset-backed token, a digital asset with an issuer, but backed by a physical asset, backed by a bar of gold, backed by a barrel of oil. So that's the taxonomy. They're all tokenized assets, and we're talking about tokenizing the capital markets, and each one of these is a different form of property.
I actually like this because it carves it at the joints pretty well. Let me go through and you tell me if I'm playing this back correctly according to your definitions, right? So a digital commodity, that would be Bitcoin. That may be the only, in your view, do you think that's the only digital asset without an issuer?
I won't say that. I won't go that far. I will say it's a very high hurdle to issue a digital asset without an issuer. It's very hard, right? It can be done. I could imagine other digital commodities. For example, China could take Bitcoin, fork Bitcoin, create China coin, and they could say, China coin is like Bitcoin, but it has special tax privileges in China, and it's only interesting to the Chinese people and 1.5 billion people. Maybe something as simple as you're allowed to mine China coin in China with Chinese power, and you're not allowed to mine Bitcoin. You would have, if everything else was the same, if there was no issuer, you would have, in theory, a digital commodity. Maybe it's not global property, maybe it's China property. But the point is, the real key is if you want to create a commodity, you need to create a network, disclaim beneficial ownership, and you can't point to anybody that has control of the destiny of the network or has some major beneficial ownership of it if you're going to achieve commodity status.
Interesting. Okay, great. So let's say for now at least, Digital commodity is sui generis, that's Bitcoin. And then for your other things, all the other 5 categories have an issuer. So an example of a digital security would be we would actually legalize crypto equities or crypto debt, crypto derivatives. For example, Uber, in theory, could now put its assets on chain. And, in another world, Uber could have given assets, in its company to its drivers so that they grew with the organization.
Can I offer a just simpler one, which is
go ahead.
Just MicroStrategy stock, if it was trading on Coinbase or Binance 24/7, 365, would be a digital security, right? Apple could be, AAPL could be a digital security. Now, I'm not saying it would only trade on Binance or Coinbase. It could trade on any, layer 2 or any tokenized network to speak of. But the point is, it would be one share, a token that represents a share of Microsoft stock or Apple stock. It's backed by the stock, but it's tokenized trading in the crypto world.
Yes, and also I think one of the things we had been talking about offline was you could imagine a site that allowed mom and pop restaurants or like small real estate operations to raise equity or debt once crypto equity was legalized, and you could have people from around the world do it. Obviously, you'd need lockups, you need various provisions for alignment, but conceptually, you could actually get a cryptographic stock certificate. You could see all the provisions of it. The blockchain would enforce timestamps, all that kind of stuff, right? If I'm not mistaken.
If you had just equity in a private company, equity in $1 million restaurant, equity in a $10 million hotel, any kind of private equity, venture capital equity, any partnership interest, any claim on future cash flows. Maybe you own 1/100th share of my Airbnb business, right? Any of those look like small private securities, but if you had a digital assets framework, maybe you would publish the relevant disclosures, sign up to the relevant obligations, and you would put those on a digital exchange, and they trade 24/7, 365 globally.
To me, this is so obviously what should happen, because let's say you've got a hotel in, I don't know, Australia, or an inn in Brazil or something like that. They can put up a website, they can advertise for customers around the world. And in fact, they can process credit cards from around the world. You've got a motel in the Midwest, and they're already processing cards. They've already got a website that anybody in the world can access. What they can't do is capital formation, which is an obvious thing to do on chain. And of course, you need all kinds of procedures and so on for this, but that's solvable, right? Would you agree with that?
I do agree with that. I think that the existing capital markets, they require you to take 4 years and $40 million in order to create an equity which trades with a 4-letter ticker. And that's the 20th century way we did it. But what if we could do it in 4 hours for $40? And I think there's another argument, which is, maybe in the 20th century, most businesses were municipal-based or state-based or nation-based. There's a lot of international podcasters. I could have an international chess podcast with 800,000 fans spread across every country on earth, and it would be very easy for me to appeal to the fans to raise capital. What if I wanted to sell half the interest in my podcast to them? They would want to buy it. I would want to sell it. But right now, there isn't really a straightforward path to a practical path for me to do that in a legitimate fashion. And so if I use the 20th century techniques, I'm at a huge disadvantage. And I won't be able to raise money. And so we're really crippling the 21st century global economy with 20th century rules for capital formation.
Absolutely. And that actually brings me to the next definition, the digital currency, right? So by your definition, which is what we call maybe a stable coin, right? An asset with an issuer backed by fiat currency. So example, USDC, or if you put some other fiat currency on chain, the USDT might be that. But USDC would be the clear version of this, where you have an on-chain USDC, you have an off-chain USD in a bank account. And if you combine that with a digital security, you could, taking your chess example, raise USDC from people around the world. All those payments would be tracked on chain. And actually, you could potentially click a button and do your accounting. And if those people had whatever, profile information, you could automatically send them stock certificates. It'd be the equivalent of what Excel was. People used to do accounting by hand, as you may remember, with, a piece of paper before spreadsheets came. I think corporate accounting is kind of like that now, but you could, in theory, have all the transactions on chain, hit a button, and it would just prepare your books for you. At least, you decide which pieces of that to have. But if you have both digital currency and digital security, you could automate a ton of compliance work. Let me know your thoughts.
I think I agree. What we're talking about is tokenizing a fiat currency or tokenizing a checking account. So, the trick to this is there's no question everybody in the world wants digital dollars. And there's no question that if I live in China or if I live in Europe and I have to pay in euros or CNY, I want tokenized local currency in those two frames of reference as well. Just like in Brazil, you might want tokenized real. So why do you want it? Well, you want it to be programmable. You want to move it at the speed of light. You want to vibrate it 1 million times a second. You want 8 billion AIs to be able to trade with each other 97,000 times an hour. It's like the utility is obvious. The challenge is, you need the nation state that issues the fiat currency to recognize it as legitimate. And then you need to overcome the privacy and the money transfer issues that, which pop up from place to place. I think we make huge progress simply by distinguishing the difference between digital currency, which is really Circle or Tether, versus digital commodities, which is Bitcoin, versus digital securities, which is your tokenized Apple share, versus a digital token, which might be any number of crypto tokens with an issuer that are, that have functionality in cyberspace or digital utility, but they're not securities and they're not currencies and they're not commodities. And the entire cryptocurrency industry has been saddled by this one name, currency. And all four of those things I just mentioned are sometimes referred to as a cryptocurrency, and the result is you just get massive pushback and fear and uncertainty and doubt. And we need to break them into 4 different categories so that people understand they're 4 different things for 4 different purposes.
I like this a lot. And so an example of the fourth, that'd be what most people think of when they think of crypto as opposed to Bitcoin. So that's Ethereum, Solana, Zcash, Monero, something that, a fungible asset that offers digital utility that's in a portfolio. And then something like a digital NFT, a non-fungible asset with an issuer. Now, NFTs are actually kind of interesting because historically people have thought of them as, a really expensive piece of digital art, like $1 million for an NFT. But now you can issue a million NFTs for $1. So you can issue like the equivalent of likes or Reddit style upvotes. You can issue those on chain as little markers of things. You can issue a ticket for a digital for a conference, either online or offline. You can use NFTs to open digital locks. So NFTs, I think, are pretty interesting. If a smart contract is on-chain code, NFTs are on-chain data. And I'm glad that you have a distinction between the fungible and non-fungible here, the digital token and digital NFT. Any thoughts on, because NFTs are on Bitcoin too as well?
Yeah, I think if you just characterize them as digital art, you're kind of underselling them. I think we got to think of them as a unique digital right. And yeah, I think about other types of rights, like maybe I'm Tom Brady and I post on some channel like on X, and I'm going to actually sell 10 superfan tokens, and numbers 1 through 10 actually get ranked in their responses underneath me. And if you always want to be the number 1 respondent, you buy NFT Brady 1. And if you want to be number 2, you're Brady 2. And if you're number 10, you're Brady 10. And if you owned Brady tokens 1 through 10, maybe that guarantees you for all of eternity, you'll always be one of the top 10 responses in that order. And there might be some super fan who's willing to pay $100,000 to make sure that their comment is always number 1, underneath Brady. It's like it's a special right. Maybe it's a key to unlock something, maybe maybe it is a piece of art, but I think, this is not quite true. I'm going to give you a physical analogy, an ABT. If I said to you, this is a token that represents 1 acre out of 1 million acres in Kansas, and they all look the same, right? That's a fungible token. But if I said, this is 2 acres, in Palm Beach, on the beach, next to the country club, right? When you get to the point where it's a specific piece of real estate, and now we think about specific real estate in cyberspace. I can create real estate in cyberspace, right? With proximity and priority. So if you start to create things that have some kind of priority or proximity or provenance, or some uniqueness, maybe there's something there that's interesting. And of course, the idea of the framework is, let's just give people the asset classes and create a Cambrian explosion of innovation, of which 99% probably won't be economically successful. But on the other hand, the 1% might be the Instagrams, the Metas, the Teslas of the world, and that'll be worth all of the other trouble.
Absolutely. And I think actually, one thing I would just say on that is, I think of there being a spectrum of fungibility. For example, you could have a 1 of 1, like a digital Mona Lisa. You could have, right, you take your Miami example, you've got maybe 10 acres of land, and each acre is its own NFT plot. So it's like, a 10 of 10. And then you could get all the way, for example, to IP address space. As you may be aware, you've got 4 billion unique IPv4 addresses. And in theory, each of those could be tradable as an individual NFT. And that would be finite, that'd be capped, there'd be a logic to it. But it'd be sort of, once you start to get to that point, they are non-fungible. You can't actually exchange one with each other, but the pricing on one might be similar to the pricing of another. And so then you get all the way to like a fully fungible token. So I think there's being an interesting continuum here. I don't know if you have any thoughts on that. Then we can go to ABTs.
Yeah, it's just obviously a million thoughts spark up, and we probably don't want to go down this rabbit hole. But I just think about all the domains. Like when you think about owning a domain, like I bought frank.com and emma.com and hope.com and angel.com.
Hope.com, great one. Yes.
Yeah, you're like, well, I don't know if they're actually physical assets or intellectual property assets, but you might very well attach an NFT to all sorts of interesting, unique things in cyberspace, and then they start to trade with the price, and they can be transferred at high speed, right? It's just a license.
Love. Okay, great. ABT. So this is essentially something which is like gold or silver or oil. It's interesting. This is what it's useful to distinguish that from a digital commodity, because when you use the term digital commodity, you mean an intrinsically digital commodity, namely Bitcoin, and perhaps uniquely Bitcoin, at least at this point, as opposed to a digital ABT, which is often a commodity like gold or silver or oil that is traded on chain. And so it's a commodity, but it's basically traded on chain as opposed to being intrinsically digital. Would you agree with that?
Yeah, the distinction is a digital commodity is an asset without an issuer, and in order to create an asset with an issuer, you're going to have to back it with some kind of digital power, whereas a digital ABT is a tokenized physical commodity. And that means at the end of the day, you're going to have a warehouse with 100,000, little gold coins, or 100,000 barrels of oil, or 100,000 bushels of soybean. And that means there's going to be a custodian, There's going to be an issuer repping to this custodian getting audited. And now you're going to tokenize whatever that is. And you're going to tokenize it so that people can move it at the speed of light, so you can slice it, so you can fractionalize it, so you can finance it, so you get liquidity on it, so you get transparency on it, so you can program it.
Amazing. So, okay, great. In math, one of my old professors used to say you can define your way out of a problem. And if you have the right definitions, lots of things follow, like abstract algebra, you have the group, the ring, the field, and then you can kind of just go downstream from that. So with these definitions, why don't we go to section 2, legitimacy. So like rights and responsibilities, right? So what you want to go through this, the path to legitimacy, issuers, exchanges, owners. Go ahead.
Yeah, I think this all boils down to there's 3 general types of actors. There are issuers, people that issue digital assets. There are exchanges, anyone that trades, custodies, and then there are owners, people that own the digital assets. Everybody needs a set of rights that are clear, and then there's a set of responsibilities. If we do it right, you could in theory have millions and millions of issuers. And you could have a lot of owners. And then I don't know why there couldn't be 100,000 exchanges dealing with millions and millions, if not tens or hundreds of millions of issuers, dealing with billions of owners. What are we trying to do? We're trying to create a global, real-time, uninterrupted process to issue, trade, and own digital assets. So in this case, yeah, go ahead.
I was going to say, I was very closely involved with this at Coinbase because when I joined as CTO, at the time, Coinbase only had 4 assets, which are Bitcoin, Bitcoin Cash, Litecoin, and Ethereum. And an important paradigm shift was for us to internally realize that asset issuers were also a kind of customer. And taking your 3 definitions, you can think of it as a two-sided market where you have millions and millions of owners and a few thousand issuers, or a much smaller number of issuers on this side. And in the middle is the exchange. Much like, let's say, the New York Stock Exchange has whatever 100 stock issuers on one side and millions of traders on the other side. So it's like a two-sided marketplace with these 3 actors. And then realizing that the issuer is a customer, sort of like Airbnb has guests and hosts, or Uber has riders and drivers. An exchange has, in your framework, owners or buyers, and issuers or sellers. And the issuer is like a special kind of customer. And of course, an issuer in one context could be a buyer in another context. And often market participants are both buyer and seller in different contexts. And I think that just having some routines and some conventions, with venture capital, one of the things I learned over the years is that every term that we had in a deal was actually something that came from some train crash in the past 20 or 30 or 40 years ago. Like, for example, 4-year vesting or lockups or co-sale rights, all that kind of stuff is meant to align, dozens, sometimes hundreds or thousands of people towards the same economic goal, where one party can't just dump on the other party or what have you. All the low trust stuff that happens, in certain parts of crypto markets, there are actually solutions for it if you actually have a organized two-sided marketplace of buyers and sellers, of owners and issuers.
The challenge here is to let all 3 of these players operate in real time, uninterrupted globally, but they need to be able to issue, trade, or own those assets. And you need to see transactions between individuals, corporations, and machines. So how do you actually create an API or a framework such that the machines can trade 1 million times an hour with each other, and they're all working for exchanges or representing exchanges, and they're all representing issuers or individuals? So you want a high-speed, low-friction market. I think about, where would we be in the world if it cost $40 million to set up a website? Or it used to be, if we think about computing, all the computing was centralized to IBM mainframes in the back office. Or it used to be with publishing, first it was just the New York Times and the Washington Post and the Wall Street Journal. And then all of a sudden people could set up their own website. But then you got those blog services where, 80 million people or 120 million people could kind of use some software as a service, blogging service. And it all comes down to, to structuring this the right way. So if you look at the next few paragraphs, right, what we're talking about is issuers should have a right to create and issue digital assets. And the obvious responsibility is fair disclosure and then ethical behavior. The exchanges should have a right to custody, trade, and transfer assets between their clients and between the other exchanges. And the responsibility is publish the asset disclosures, protect their client assets, and then avoid conflicts of interest. And then for owners want the right to self-custody, trade, and transfer their assets. So it's, you're back to the not your keys, not your coins, but it's not so much an obligation to self-custody, but a right to self-custody and the right to trade, the right to transfer. That's important. And the responsibility, comply with the applicable local law, whatever that might be. And of course, what I think is the big idea here is create some foundation principles like nobody has the right to lie, cheat, or steal. By the way, this is kind of obvious. I don't even know if you would have to say it, except for the fact that if you started from the observation that people don't have the right to lie, cheat, and steal, there's probably 100,000 pages of regulations you wouldn't have to publish, because most of them all boil down to that. And if you simply made those three observations and then you noted that participants are civilly and criminally liable for their actions, you might very well eliminate 100,000 pages of regulations, years and years of review, and somewhere in the range of $10 million a year of compliance costs with lawyers and all the back and forths that go into this process. So I think it's a place to start.
Well, the thing actually, it's funny, when I looked at this, I was like, wait a second, there's only 3 pages. And, but I like how you've set it up, because you're right that by just articulating those sort of 10 commandment-like principles, that actually does distill the intent, or at least the stated intent of so much regulation is all the disclosure stuff says you're not hiding something. It's not a material misrepresentation, aka don't lie, right? Or you're, for example, a disclosure of when an executive is going to sell what amount of stock, don't cheat, right? That kind of stuff, right? So lots of specific things are sort of downstream implementations of these sort of very simple 10 commandment style moral directives.
And yeah, it's back to this issue of it pops up in censorship. The question is, do I have to hire 100 lawyers and file paperwork with the regulator for 3 years before I can publish my opinion on X? Or can I actually publish the thing that I wrote on X with an understanding that if I slandered someone, if I lied, or I cheated, or I stole through my misrepresentation, I have civil liability. If I publish something that gets somebody else killed, maybe I'm going to get tagged for manslaughter. But, we have examples in product development and in the media. Yeah, it doesn't take $40 million to design a product and sell it to someone. But if you create a product that's unsafe and you sell it to them and it kills them, you do have civil liability that the thing you sold killed the person, right? So there's a lot of industries that function with this set of observations. And those are industries where people can do things in one day or do something in 1 week. But at the point that you implement a nanny state, and you take the position that no one's allowed to say or do anything until it's gone through progressive layers of censors, what you really do is you choke off 99.999% of all innovation.
Absolutely.
Everything stops.
It's the difference between pre-market review versus post-market review. Do you presume everybody's a criminal, or Do you allow people to transact and then make clear that criminals will be punished afterwards and what criminal behavior actually is? It's not really, it shouldn't be a process violation. It should be a principle violation. One other thing I wanted to say is that the concept of buyers and sellers being connected by an exchange as a two-sided marketplace is so obvious, but there is actually one very unique aspect of crypto versus traditional stock markets. And maybe you have some thoughts on this. With traditional stock markets, like when a tech company files to go public, it's only choosing between NYSE and NASDAQ, let's say, at that time. And they do compete for the business and, what have you. But then after that, it's not easy. I don't think it's actually, I'm not aware of prominent examples. Maybe it's possible, but to move the asset from one exchange to another, from NYSE to NASDAQ, is not that easy, number one. And then number two is there's no equivalent of send and receive. People can't load their NYSE shares on, or let's say their FB shares onto NYSE, pull them out, self-custody, load them onto NASDAQ and trade there. It's not the equivalent that you have with Bitcoin. Now, conversely, in offline markets, if you have, let's say a farmer has a bunch of apples, they can go and sell them at this supermarket or that supermarket. They have the send and receive equivalent, but they don't have the speed and the global aspect of the digital. So this kind of two-sided marketplace combines the scale and speed of digital markets with the optionality of physical markets where you can withdraw from one market and go and sell in another market. Let me know if you have any thoughts on that.
Yeah, well, what we're talking about is conveying property rights to all of these 20th century assets that don't currently exist. For example, right, I have a bunch of Apple shares, but I can't take custody of them. The 20th century world is one or two settlement networks, one or two custodians, one or two exchanges. You have a very limited set of options, and there isn't really a competitive market. So in a world where you had 1,500 digital exchanges in every place in the world, and they could all handle any of these assets, sorry, you might see someone that wanted to give you a credit line on your Apple stock, or they wanted to give you a yield on it. Or, maybe your bank will give you an advance ratio of 50%, but there's a bank in Europe that'll give you an advance ratio of 95%, or they'll actually give you a mortgage where you can top up, with tokenized, barrels of oil. Or, right, you could have competition if there was competition, but the problem is, there isn't competition. The owner of the asset doesn't have the right to take custody, to transfer custody, to shop out the asset to the highest bidder. And maybe more to the point, what if I had an AI program and it had my entire portfolio of assets, and every minute of the day while I'm sleeping, it's actually gathering a bid from 150,000 corporations all around the world, asking them for the highest bidder for me to loan out the assets or custody the assets or whatever they want to do with them. And it's just in a fluid way moving my capital all around the world in order to get me what I want within my risk parameters. That can happen in a tokenized world. But if your asset is 100 acres of Kansas City real estate in the suburbs, there's like one bank in Kansas City that may or may not want to finance it. And if that bank is not interested, none of the other 100,000 banks in the world are going to want to touch that asset.
Yeah. And I think one thing that's interesting is scale enables the long tail. Scale is actually good for the small, because if there's only 10 lenders, one of those lenders may not want to take a chance on some small business. But if there's 10,000, then one of them may actually want to take a chance on that small business. There's more risk tolerance if you have larger markets. There's people who are willing to try out smaller things, and it's kind of like, with enough drivers, somebody will be able to pick you up they will take the job of picking you up from this street in this suburb and drive you into New York or what have you, right? So there's a sense in which the scale is actually very good for the little guy because it allows them finally to have access to the same capital markets that the big guys do.
And I get to that in my section 4 of the framework here on vision.
So why don't we go to section 3 and 4? So 3, practicality, right? Rational compliance to empower innovation. And so I think this is related to thou shalt not lie, cheat, or steal. You're really trying to bring it back to simple, short, go back to the spirit of the law rather than the letter of the law. Why don't you talk about this?
Well, the first principle is we want to prioritize efficiency and innovation over friction and bureaucracy. The existing system prioritizes friction and bureaucracy. Everything takes too long, too many lawyers, too much money. So how do you prioritize efficiency and innovation? Well, you start with simple principles like don't lie, cheat, and steal. Then you define data structures for each asset class. What are the common data structures, right? This is how you write a computer program, right? It's not that complicated. If, for example, you want an ABT, you want to know what kind of asset is it? Where's the asset stored? How do I know the asset's there? How many of the assets are there? Who's the counterparty, et cetera. And you would have a different data structure for a currency versus a token versus an NFT versus a commodity. But once you define the data structures, every digital exchange in the world can support those data structures, and then you can create a client that publishes the data structures. You create all the audits. So that's standardized disclosure. That reduces the friction. Instead of like 200 pages of custom legalese for every security, you've got one data structure and you convert a 3-month process into a 3-hour, 3-minute, or 3-second process. And the second idea is industry-led compliance. If you define the data structures, then the exchanges can collect and publish the data, as a service to the issuers, to the investors, to the other traders, etc. And that helps you get to the third element here, which is cap the cost. If you want it to be a real business, you can't afford to spend more than 100 basis points of the assets you issue in order to issue them. So if you're gonna raise $100,
that's a lot, by the way. 100 basis points for people who don't know. Like 1 basis point is 1/10,000th. So 100 basis points is like 1% of your asset. That's extremely expensive. Go ahead.
What I'm saying is, if you wanted to raise 100 million, you definitely can't spend more than $1 million. Now, 1% might be a big investment banker fee or a fee you might pay. I came public, and when we came public, sometimes, the fees were up to 6% for a small deal, 3% for a bigger deal. But, we might pay 1 or 2% for a big deal if we're doing a bond deal. But here's my point, the big point. It costs $10 million a year in order to stay public, to be compliant, and you might spend $30 or $40 million to get public. And so it's pretty obvious that if you want to raise $1 million, you can't pay $40 million for an insurance policy, and you can't spend $10 million a year in order to raise $1 million, right? It's kind of like saying you gotta basically buy a $10 million insurance policy to publish a website or express opinion on X. Or to post a video on YouTube, you gotta buy a $10 million a year liability insurance policy.
They were trying to push the world in this direction over the last few years, the establishment was, and fortunately they lost. But they were trying to do this.
Yeah, I definitely can see it. And here's the sad fact, Balaji, which is they did do it in 1933 for all publicly traded assets. They didn't lose. If you read the history of money and banking by Murray Rothbard, something like 50 years ago in the last century, he wrote about the formation of the modern SEC, and he writes about the SEC 33 Act. And one thing that he points out long before the crypto industry was formed is he says, The SEC 33 and 40 Acts, they were put in place to centralize control over the capital markets in Washington, D.C. and limit access to the capital markets to a very small cartel of large issuers that could be overseen by the government. And, he has another observation. He thinks it was the Rockefellers' interest edging out the J.P. Morgan interest and shutting down too much entrepreneurialism in New York City. It was a DC
It's funny
power
you say that
grab.
because I wanted to put something on screen for a second, which is exactly this. The SEC essentially was set up to limit self-allocation, right? To put allocation of capital in the economy placed under federal control. A planning agency would assign capital industries and then apportion the allotted capital, right? The need would decline, right? So a federal planning agency, not the securities industry, would operate the process by which capital is allocated through the economy. So this was the whole point of the SEC was step one, control capital allocation in the economy itself, right? And just go ahead.
Yeah, you think about it, I think there's a certain Stockholm syndrome. Or remember in Star Wars, they say these are not the droids you're looking for, and there's this Jedi mind trick. It's like, raising money from the capital markets is not for you. You're too small. That's not for me. I'm too small. That's only for billion-dollar mega corporations, but you're not that. So raising money is not for me.
And it didn't used to be like that. It used to be that a small cap could go get out there. It's modern Starbucks make it so expensive.
Yeah. So it comes down to the issue of, are you going to let adults take risks and lose their money, right? Are you going to impose a $10 million insurance policy to keep someone from taking a $100,000 risk? And if you do that, the result is that 99.9999% of the action can't take place because of the crippling regulatory burden, because the government wants to keep anybody from taking a risk or losing their money or making an investment that might not pay off. And it comes down to a free market view. Do you believe that free markets will make the right decision? Or do you want a centrally planned economy? And do you think a set of bureaucrats at the headquarters should just decide every single business decision and every allocation of labor and capital, and talent in the economy so as to, quote unquote, not make a mistake?
Well, take a look at this. So this is the peak number of listings was mid-90s. And then, especially after Starbucks and so on, it basically just fell off a cliff to almost 70% drop in the number of, listed equities because the price went up so high. And I thought your phrasing just now of $10 million insurance policy to prevent a $100,000 loss by somebody is a really good way of thinking about it, where the insurance is so expensive. Basically, people are only thinking about risk. They're not thinking about reward, and they're not properly calculating the cost of that risk. And the whole thing is just a pile of paperwork versus being rational about it.
Yeah, I've lived through that, Balaji, because I came public in 98, and I think there were about 10,000 plus public companies. But over the next 20 years, 60% of them disappeared. And basically what happened was, with Sarbanes-Oxley and with the encroachment, the progressive encroachment of the regulators on the public markets, it just became so brutally painful and expensive and risky and anxiety-inducing to be a public company. People just said, screw it. I don't want to do this anymore. And they all went private. And paradoxically,
that led to the rise of the great tech companies, because it meant that Zuck and others could not for many years in tech. The wisdom was, don't go public as late as possible. And the good thing about that is it meant that they controlled their companies all the way up. And so they could have voting control and they could make bold decisions and so on. For the public, the bad part is that they actually missed out on the upside of that. With Bitcoin or with cryptocurrencies, they actually have an ability to get that upside. But for many of the giant tech stocks, most of the upside happened before the public markets. There's exceptions, the big exception being NVIDIA, or Apple, arguably. But still, it's something where a lot of the upside was not available in the public markets because of that. Let me know your thoughts.
Well, I think there's about 40 to 50,000 publicly traded companies in the world. There's 4,000 in the U.S. But that really understates the problem, because of the 4,000 in the U.S., there's only about 400 or so that are well-known seasoned issuers. So that means there's 400 companies, maybe 600, that can file a registration statement and sell securities the next day or within a couple of days without waiting for approval from the SEC or from a regulator. On the other hand, there's 400 million businesses that can express an opinion or create a product or improve a product. So if you look at the economy for products and services, it's evolving at a very rapid rate. But if you look at the economy in the capital markets, and you look at the rate at which we can develop capital assets, they're crippled and evolving at a very slow rate. And if I want to do something as simple as, maybe I want to tokenize a Picasso painting. Well, you own the painting, it's worth 10 million bucks, and you want to sell 100 shares of it, and you'd like to float that, on an exchange. There's a global market for it. People would like to own it, but it would cost you $40 million to take a company public, and $10 million a year. So you see, at some point, it just, you can't capitalize, you can't legally, practically tokenize an asset that isn't $1 billion asset. So what we've done is we've capped the market such that if you're not running $1 billion to $1 trillion enterprise, the capital markets don't work for you, right? And the crypto economy, the crypto markets, they've tried to overcome that. And they've issued millions and millions of crypto assets, but they haven't been legitimate. They've been deemed illegitimate, and that's why we've had the war on crypto. And so this framework would allow us to create legitimate digital assets. And the way you'll know it worked is you can actually tokenize a $10,000 asset, $100,000, $1 million, $10 million, $100 million, $1 billion, $10 billion. It's hard to defend the status quo, even because, there are examples of successful companies that are monsters, but they would have been successful despite regressive regulation. So I would argue that Apple stock would be more valuable if it was tokenized and it could travel to any iPhone or any Android phone anywhere in the world on Saturday afternoon. People would find it to be better collateral than it is right now. There would be a lot of innovations. My point is, it's not practical to issue an asset if it costs more than 10 basis points a year to stay compliant. And you can pull that number by looking at the ETF industry, and you'll see that any democratized asset issued by BlackRock, or look at like SPY or others, when they get to more than 10 to 20 basis points, they get crippled. You can spend 10 basis points. 10 basis points means that over a decade, you give up 1% in order to stay compliant. But when you get to more than that, it means it's kind of a regulatory encroachment. It's so much friction, it's crippling you. If you want the industry to come to life, you need to take the regulators off the critical path of issuing assets. You can't file to tokenize your Picasso and wait for 3 months.
Oh my God.
Right?
Yeah. It's the thing about this is it's actually deadweight loss, right? Those delays make less money for actually the government, for the seller, and for the buyer. They just, the whole concept of imposing queues and waits and delays for no reason is something that just costs everybody in the system money and doesn't gain anybody anything. Maybe obviously.
The case is worse than that, Balaji. It's like I said 3 months, but the truth is, if you want to actually tokenize an asset legitimately in the United States, it would be 3 years of work. It's 3 years of work, $30 to $40 million of accounting and lawyering. Then it would be 3 months of filing the paperwork. Then it would be $10 million a year to stay compliant. So if you think about everything else in our world, think about the entire innovation economy. If it took you 3 years to publish a webcast, if it took you 3 years to come up with a new idea, right? It just takes too long. And so, and the answer is, it's like, imagine if it took you 3 months to get permission to drive your car out of your driveway to go across the city, right? Or it took you 3 months to get permission to put food in your mouth. Or to breathe, right? It's just ridiculous. But that is the problem we have today. And the answer, of course, in an enlightened society is, if you drive your car out of your driveway and you run over a bunch of school kids because you're speeding and drunk, you have criminal liability and civil liability for operating the vehicle in an unsafe fashion. So what we ought to do, and we do the same thing with like posting things, and we do the same thing in every part of our economy that works. We let people think for themselves and innovate and create and find a customer, and then they're civilly and criminally liable for their actions. And so here, what we need to do is just take the regulators off the critical path. We need to have a set of data structures. The industry will create a set of services, and then if you have 100 Picassos and you want to tokenize all 100 of them, you take the photo, you post the certificate of ownership, you upload it, you publish it, you offer it to the public, the market forms, maybe the IPO fails, maybe they succeed, maybe you sell the thing and you're a cheating criminal, and then someone sues you and you go to jail because you committed criminal fraud. All that stuff just needs to happen, right, in a rational fashion. It needs to happen a million times faster. So that's the idea of a practical framework to do this.
The only thing I would just say about that is it's possible. One thing I think about is regulation is like binary classification. If you know the concept of a binary classifier, for example, you're for each security issuer, either they are good or bad, and then what you detect them as being good or bad. So you could have a true positive, a false negative, a true negative, and a false negative. And so, for example, you're detecting good guys versus criminals in terms of issuers, or it's like similar to a molecular diagnostic. You're looking at someone who's, whether they've got a disease or don't have a disease, and then your readout, your test says positive or negative. And so you could have all four possibilities: true positive, false positive, true negative, false negative. And we actually start measuring the regulatory state by the speed and quality and cost by which it actually makes these classification decisions. And so you mentioned one variable, which is they should do it a lot faster. Another thing is we should have independent regulators. For example, if you have regulators from different states or cities or countries, and they have the same judgment about somebody, that's actually one thing. Versus if they have different judgments, it's sort of like, let's say there's a driver and they don't like their rating on Uber. They can actually go to Lyft instead, and maybe they just had a bad experience on Uber, for example. So I think that there's something to that where you actually have some check and balance on the regulator itself, where you start looking at their history of correct classifications. Because the reason I say that is with the SEC over the last 3-4 years, they were not going after FTX. In fact, they were meeting with Sam Bankman-Fried while they were attacking many of the legitimate projects in the space. And Ben Horowitz has talked about this, that it was almost like an intentional thing where they wanted the space to be littered with scams and frauds and go after the legitimate projects, so that this way it would just kind of corrupt the whole space. I would say, go ahead.
Yeah, I'd say being charitable, it's just hopeless for a government agency to do some of these things, but it's
in the West. I would agree with you. Yes, and that's why I think a lot of this is going to be led by tech companies. So, go ahead.
Well, let's take eBay, right? What we really want is a marketplace to form like eBay, where you didn't need to get government permission and wait for 3 months in order to list, your comic book collection on eBay. But at some point, the sellers have a reputation, or the issuers in that case have a reputation, but eBay had an interest. And over time, the free market kind of figured out how to figure out who to trust, who not to trust, and how to take risk and how to clear the market. So, you would think that a digital exchange like Coinbase or Binance will start to apply, AI and modern techniques to figure out whether someone's getting ripped off or not getting ripped off, and over time, people will work it out. But what's clear is that's why I think we wouldn't have 1,500 exchanges. You might all of a sudden see Apple and Google and Meta get into the business, and Microsoft, and you might see all the banks, and you might see lots of Wall Street firms and hedge funds, and then you've got the natural short sellers and the natural arbitrageurs. And in a world like that, there's a lot of people that will write a computer program that sifts through 10 million things at the speed of the computer, and they form an opinion about whether it's a good thing or a bad thing, and they short it or they go long it, and just let the market cook, right? The key point here is the market just doesn't work if there's a regulator on the critical path, so they need to publish some standards and guidelines, get out of the way, and then you will actually have a practical path to compliance, and then you can empower innovation. And then, what you're getting is exponential improvements. You're going to get exponential improvements in cost and speed and accessibility. Just like what's happening with all these AIs right now. You're looking at these things and they're changing every week. Right. And on the other hand, Balaji, I can legitimately tell you that I came public in 1998.
You survived quite a downturn. You yourself are actually that's why you can be in Bitcoin, because you survived this giant downturn and you survived all the way through and rebooted.
I did. I lived through 99.9, 99.87, maybe 99.9% downturn.
Oh my
there
God.
And back again.
Wow.
But here's the point I'm going to make. I haven't seen an innovation in the way that my stock trades on NASDAQ since we came public. Not one. It trades the same way. It's literally the same thing for 26 years.
The only innovation is just HFT guys, which is not really an innovation. That's it's arbitraging the thing that shouldn't matter, which is like the ping time to, where the actual exchange is in downtown New York. Go ahead.
I'm like, well, for the issuer, we got one thing. We got the at-the-market ATM. We got that one thing that was somewhat useful to us, but there was nothing else. So if you think about what happens when the regulators get out of the way, you would have 1,000 exchanges all competing to provide the best service. The irony is, within about a year of us getting into Bitcoin, Binance was trading MSTR token on Binance 24/7, 365. So we actually had the first innovation in the crypto economy from a company not even in the U.S. And of course, the result was the German regulators shut it down. Like the one innovation that took place, and the regulators' view was we just have to stop that as opposed to let that continue. Let's go on to the vision. So the vision is, instead of taking $10 to $100 million to issue an asset, we move the price or the cost to issue an asset to $10 to $100,000. Right? Let's change by orders of magnitude. Instead of taking months and years to issue assets, let's change it to hours or days. The amount of time it takes you to post on Airbnb, or the amount of time it takes you to post on eBay, or the amount of time it takes you to post on X or YouTube. Let's change it. And then instead of having 4,000 publicly traded issuers in the US, let's shoot for 40 million. And instead of limiting access to the capital markets to very, very large companies, let's empower small businesses. Let's empower artists, celebrities, mid-sized enterprises. Let's empower them to tokenize assets, and let's expand dramatically the asset classes. Right now, people think about things that trade on Robinhood. It's like, what can you trade? You can trade like equity for the most part. But if you look at the market of preferred stocks and assets and commodities and collectibles and IP and brands, most of those things don't trade via 4-letter ticker on Robinhood. It's there isn't that much art that's tokenized. It's very difficult to do it. It's hard to tokenize real estate. It's hard to tokenize other things people might want to buy. If you look at publicly issued fixed income instruments, of which there's 300 trillion of them, most of them trade over the counter. The spreads, the bid-ask are very wide. They're illiquid. So it's like a 300 basis point spread to buy or sell a bond. There is no quote. It's a dark market. You need a $25,000 subscription to Bloomberg to even get the quote. So why is it that we block 99% of the investors and then we have 300 basis point spreads instead of 3 basis point spreads? And why is it that so much asset is sitting? Why is it that most of the art in the world is sitting in vaults underneath mountains in Switzerland and not trading, right? They're dead assets in cold storage, just like your cryptos in cold storage. And it's because we haven't really democratized access to all these things. So I think with the right framework, we can usher in a renaissance where you can tokenize hundreds of trillions of dollars of assets. And I'm not talking about just Bitcoin. What I'm thinking is Bitcoin is just the capital asset. I'm thinking that we'll get to $500 trillion worth of equity, real estate, commodities, collectibles, arts, and new digital assets that will be created and legitimized, digital NFTs, digital tokens that never existed before, right? And then there'll be a whole range of products and services that come to life on top of those digitized assets that are inconceivable right now. Like most people, if they hold equity, like if you hold $100,000 of equity, it's not likely somebody wants to give you interest. It's very difficult to get paid interest. But there's someone that wants to short that equity. So in theory, you ought to be able to collect 450 basis points. Like if you have $1 million of equity, why can't you get paid SOFR on the $1 million by someone, or half of SOFR? Because in theory, a bank might very well post that block of asset and charge the SOFR rate and split that interest with you. And the reason that you don't get paid interest on $1 million of equity, but you do get paid interest on $1 million of treasuries, is because one asset gets superior treatment by your bank, and the other asset, the bank feels like it doesn't really need to.
Right, but it could be you could have the benefits of full custody while also maybe getting some return on that asset, where it's just much more agile. It's more liquid. It's more visible. It's more collateralizable if it's on chain.
Or maybe I would just say you ought to have the option to have the benefits of full custody, which is you own it. It's a bearer instrument. It's tokenized on your handheld. Or if you're willing to loan your assets out to a bank and let them rehypothecate it, you ought to have a choice of 1,000 different banks. And maybe there's someone in Singapore that'll give you a better deal than the bank in New York City, or somebody in London or Paris, or fill in the blank. And, granted, maybe they're untrustworthy counterparties and they're going to rug pull you. But the real point is people ought to have the freedom to own their own assets or trade their assets or custody their assets. And the marketplace ought to be able to form capital markets. Maybe it's not, maybe it's I'll give you a loan against it. Maybe it's I'll give you interest on it, but maybe it's something different. Maybe it's I'll form a derivatives market. Like, for example, if I can tokenize a bunch of old masters' art, then maybe someone else can create a derivative of old masters' arts and sell me futures on it, right? Or maybe I can short it or go long, or
basically we can make all these combinations that we couldn't make before.
Yeah, and that market comes to life when you are able to pool $1 billion of liquidity on a global basis. And that market, and by the way, when you publish it and you trade it 24/7, but when you have an illiquid pool in a dark market with someone with a monopoly on it, one of the problems is you've got one bank in Kansas and they're the market maker on real estate in Kansas, and they set the price, they set the bid ask. And no one else gets to enter that market. No one else has transparency. And so instead of them giving you the highest common denominator, they're the lowest common denominator. And there's a pretty big difference in the way the markets function when everything is up for bid to everyone all the time in real time with transparency. And that's a world where everybody just gets treated better.
Absolutely. So let me see if I can recapitulate your PDF. You have these 6 definitions, which cut the space in a useful way. Next, we define these 3 categories. We have the buyer, the exchange, and the seller. And anybody can be any of these 3 things. But the overriding principle is not paperwork. It's not cost. It's not delay. It's not bureaucracy. The overriding principle is just don't lie, cheat, and steal. And this 21st century securities and markets regulation, if designed in this way, would be something where any mom and pop could raise money, where it's similar to just like any business can go online, any asset can go on chain, where people can raise debt, where if you've got a chess podcast or a chess website in Florida, which has a global audience, you can actually raise from that audience. All these things that are obvious to us that should happen, could happen, and the new administration could be a leader in this. Is that a fair summary of your analysis?
Yeah, that is a fair summary.
Awesome. Well, Michael, this was great. Thanks for being here, and we'll see you soon, and maybe I'll see you in Miami next time I'm out there.
Yeah, thanks for having me.